Every time the Federal Reserve breathes, your phone blows up with panicked headlines about interest rates, inflation, and the impending death of the economy. You see terms like hawkish, hyper-quantitative tightening, and basis points, and wonder if you should be selling your index funds or buying gold bars. The truth is that most of this noise is designed to scare you. The Federal Reserve isn't a shadowy group of bank villains deciding your personal net worth. It is a group of 12 regional banks led by a board of governors in Washington, D.C., currently chaired by Jerome Powell. Their mandate is incredibly simple: keep prices stable and maximize employment. They do this by controlling the federal funds rate. Think of this as the cost of money. When they raise it, everything gets more expensive. When they lower it, borrowing becomes cheap. To understand why Gen Z is constantly losing sleep over these announcements, we have to go back to March 2020. COVID-19 hit, the economy froze, and the Fed panicked. They slashed interest rates to near zero. They printed trillions of dollars, technically called quantitative easing, to flood the system with liquidity. It worked, but it created a massive side effect: runaway inflation. By 2022, the Consumer Price Index, or CPI, hit a 40-year high of 9.1%. Your groceries, your rent, and your gas prices went vertical. The Fed had to pivot. In March 2022, they started a massive hiking cycle. They moved the benchmark rate from near zero to a range of 5.25 to 5.50% in just over a year. This was the fastest pace of rate hikes since the 1980s. This is why you saw your high-yield savings account suddenly paying 5%, but your mortgage rates jumped from 3% to 7%. They were trying to break the economy's fever by making money too expensive to spend. Why does this freak out the internet? Because the Fed is essentially trying to perform heart surgery while the patient is running a marathon. If they keep rates high for too long, they cause a recession and mass unemployment. If they drop them too early, inflation roars back to life and destroys your purchasing power. This is the soft landing everyone talks about. It is the economic equivalent of threading a needle while blindfolded. When a news outlet says the Fed is being hawkish, it means they are worried about inflation and want to keep rates high. When they are dovish, they are worried about the labor market and want to cut rates to stimulate growth. Jerome Powell speaks in deliberate, boring code. He uses phrases like data dependent or higher for longer. Every time he hints at a change in direction, the stock market swings by billions of dollars because algorithms interpret these words faster than a human can blink. Gen Z is uniquely sensitive to this because we are currently in the most critical stage of our wealth building journey. We are trying to buy our first homes, pay off student loans, and start businesses in an environment where the cost of capital is fundamentally different than it was for millennials or Gen X. For the last decade, money was essentially free. Today, money has a cost. That transition is painful. Let's look at the actual math. If you want to buy a $400,000 home, a 3% interest rate results in a monthly principal and interest payment of about $1,686. At a 7% interest rate, that same home costs you $2,661 a month. That is nearly a $1,000 difference every single month. That isn't just inflation. That is a fundamental shift in your lifestyle and your ability to save for the future. The panic in the headlines comes from the uncertainty of this transition. Nobody knows if we are heading for a no landing, a soft landing, or a hard landing. When you read a headline that says Fed signals potential rate cut, it doesn't mean they are fixing your life. It means they are acknowledging that the economy is cooling off. If the economy cools off too much, you lose your job. If it stays hot, you can't afford an apartment. It is a double-edged sword that keeps every economist in the world awake at night. The Federal Reserve's power is psychological as much as it is physical. By simply signaling what they might do, they change how banks lend, how businesses hire, and how consumers spend. They are the puppet masters of the American business cycle. But remember, the Fed is reactionary. They don't predict the future. They look at the past month of data and react. They are usually 3 to 6 months behind the actual reality of the economy. If you are seeing headlines that make you want to liquidate your 401k or stop investing, take a step back. The stock market historically hits new highs over the long term. regardless of who sits in the chairman's seat at the Fed. The volatility you see today is a result of the market trying to guess the Fed's next move. It is a high-stakes game of poker, and the only people who consistently win are the ones who refuse to fold their hands when the headlines get loud. So, the next time you see a notification that Jerome Powell is speaking, don't rush to move your money. Look at the long-term trend lines. Inflation is a tax, and high interest rates are a blunt instrument, but ultimately, the economy is powered by the productivity and innovation of the people living in it, not just the interest rate set in a DC boardroom. We are living through a historic reset of how the global economy values money. It is uncomfortable, it is expensive, and it is confusing. But the real question you should be asking isn't whether the Fed will cut rates by a quarter point in September or November. The real question is how you are positioning your skills and your assets to thrive in a world where the era of free money is officially over. Are you playing the headlines or are you playing the long game?